welcome everyone to day 3 of the PM revision session, and I will be looking into part D of the syllabus in this particular session. Okay folks, so we will be covering all the key topics which are relevant for part D, budgeting and control. So let's have a look at it one by one, shall we? First of all, there is of course the top-down and bottom-up budgeting methods, and its of course advantages and disadvantages. Well, when it comes to PM, it is important that you guys know about all of the advantages and disadvantages, at least a few. Okay, folks, it doesn't have to be 8 advantages and 8 disadvantages, or 10 advantages or 10 disadvantages. At least remember 2 or 3, so that you can score the maximum marks in the exam. Because if certain concepts are tested, let's say for example, in one of the previous past exams, you might find a question related to ERPS system, which is from your syllabus part A, right? So they have asked the question like, hey, how exactly can an ERPS system be relevant to a particular organization, right? So even though the question is phrased that particular manner, you still have to provide the advantages, or you have to talk from the perspective of the advantages and the disadvantages that you know of that particular system, right? So that's basically the thing. Whatever concept or whatever concept is being asked in that particular question, you need to know at least 1 or 2 of the disadvantages and advantages of that particular system as well. For example, I have the top-down management system over here, right? So what is the advantages and disadvantages of top-down approach? Top-down approach is basically when the particular instructions are being provided from the top to the bottom, right, to the junior level management, right? So that's basically the idea. So in such a situation, what are the advantages and what are the disadvantages? Advantages would include that it is a quick and easy process, if you think about it, right? Just give them the command and they'll follow it, right? That's basically it. And what other advantages do you see in that? We can get things done in a bit more quicker manner, right? And of course, the employees would be clear on what to do as well, right? Since it's clearly instructed, they're very clear on what needs to be done, right? And we can take spontaneous, or we can respond to spontaneous situations using this particular approach as well, right? Right? For example, if there's a huge change in the environment or a huge risk that is impacting the organization, then by using a top-down budgeting approach, we can quickly respond to that particular change as well, right? So that's basically one of the key advantages of a top-down approach. Are there any disadvantages? Most definitely yes, because some employees would be a bit demotivated, right? Because they're just following instructions, their opinions or their recommendations or their viewpoints are not taken into consideration, so therefore staff morale might decline, right? And at the same time, another disadvantage would be that when it comes to certain organizations, it might be a bit difficult to implement this, right? Because there would be resistance and stuff like that as well, right? For this particular approach, right? So there are multiple things, right? So like there's at least 2 or 3 advantages and disadvantages needs to be remembered, for this particular topic. And then you have the next topic, which is bottom-up budgeting. So what's the idea here? We start at the lower level management and then go up, right? That's basically the idea, bottom-up. So, the idea here is that the top level will consider the opinions and viewpoints of the bottom level or their subordinates, and then set the budgets accordingly. Now, this way we can make the targets a bit more realistic. That's one of the advantages, right? And of course, staff morale will increase as well. And what are the disadvantages? The disadvantage would be that when it comes to bottom-up budgeting, it's a time-consuming process, right? And of course, we cannot respond to certain changes in the industry as quickly as we would expect, because we have to discuss with the bottom level, and then negotiations need to be conducted, etc. Okay, that's basically the idea. So, depending upon the situations, you have to change from a authoritarian leader to a participative leader as well, and vice versa as well, right? So that's basically the idea. Okay, folks. So both of these approaches are well known in the industry and can be taken at any time as well, but depending on the factors of the business environment. Okay, folks. If you need to take a quick decision, then we would much rather prefer top down. Whereas if we have the time and we need to make realistic standards for our budget, then I would say bottom up would be much more realistic, right? So that's basically the idea. And then we look at the types of budgeting, right? So what all types of budgeting are there? First of all, we have the traditional way of doing or preparing budgets, which is basically incremental budgeting, right? So what is incremental budgeting all about? The budgeting method using current year's actual results, right? That's basically as to what the idea here is. So in incremental budgeting, what we basically do is we take the actual results of the previous year, right? Make some adjustments to it to create the next year's results as well. Okay, folks, that's basically as to what incremental budgeting is all about, to put it in very simple terms. Okay, folks, and then again, we have the advantages and disadvantages, right? So guys, incremental budgeting, it's important to know what kind of organization uses this type of budget as well. So incremental budgeting is much more preferred by those organizations operating in a stable environment. Okay, folks, if their business environment is stable, as in if it's not changing continuously, then an incremental budget is perfect. Okay, folks, so the advantage is that it's a really quick and easy thing to do or prepare, right? There's not much administrative effort needed as such, right? And secondly, this thing, okay, folks, it's much more suitable to stable organizations as well. The disadvantage of this particular budgeting process is that we're carry forwarding unnecessary inefficiencies from the previous year as well. If we were inefficient and if we incurred more costs in certain areas, then we would be carrying forward those inefficiencies as well, right? So that's basically the thing. And and these inefficiencies can get built up in future years as well, right? So that's basically one of the key disadvantages of incremental budgeting as well. Alright, moving on to the zero-based budgeting process as well. So what's the idea here? So when it comes to zero-based budgeting, the idea here is that we're not going to carry forward anything from previous year and make inflation and exchange rate related adjustments or anything. Okay, folks, we're not doing that, right? Instead, we're starting everything from scratch. Okay, folks, we're starting from the basic, from the scratch, so that the budget is not carrying forward any inefficiencies that occurred in the previous year. Okay, folks, so that's basically the idea. Each and every item which needs to be included in a zero-based budget would be scrutinized, right? And then it will be evaluated properly before getting included. And how does the process work exactly? Each item that needs to be included in the budget are considered to be categorized into certain decision packages, and the management will have to involve their considerable amount of time and judgment to evaluate each decision package and to rank them and then decide what to include and what not, right? So that's basically the idea. So the key advantages of zero-based budgeting is that it does not carry forward any inefficiencies as such, right? And it is it is more suitable for those organizations which are project-based. Okay, folks, so for project-based businesses, zero-based budgeting would be perfect. And then as a disadvantage, what I would say is there would be a considerable amount of time, management time, that would be needed in implementing this. And then some managers may find it to be a waste of time as well. Okay, folks, so that's basically the idea. So yeah, that's basically as to what zero-based budgeting is all about as well. Now moving on to rolling budgets. So what's the idea here? So when it comes to rolling budgets, it is continuously updated by adding periods to the end. What does that mean? Well, basically, if I am preparing a budget for the next 12 months, right? After 1 month is over, I would have some, actual results, right? I would have some actual results with me, right? So what I'm going to do is, I would be carrying forward this particular actual results. I would be I would be revising my budget for the next 12-month period. Okay, folks. Once one particular month is over, and once I have the actual results, I would be carrying forward the actual results. So that's basically as to what rolling budgets are all about. So yeah, coming back. So when it comes to rolling budgets, what's the idea? Again, we are trying to prepare a budget for 12 months, right? And after preparing, after getting the actual results for the first 1 month, we'll be revising it for the next 12 months again. So when it comes to rolling budgets, we are continuously updating it on either a monthly basis or on a quarterly basis as well, depending upon the organization. Okay, folks. So that's basically the idea. So when it comes to rolling budgets, it's much more suitable for those organizations that are there, in a dynamic business environment. Okay, folks, a dynamic business environment would mean those businesses that operate in a changing business and continuously changing business environment, such as, let's say, the smartphone industry or any other technological industry, or maybe even the fashion industry as well. So trends and customer expectations keeps on changing when it comes to these industries, right? So that's basically the idea. Okay, folks. So that's basically what rolling budgets are all about. And then we also have activity-based, budgeting as well. So when it comes to this particular budgeting process, this is more suited for complex organizations. Why? Because when it comes to this particular, kind of budgeting, what we do is we basically, apply the ABC principles. ABC as in activity-based costing principles into creating the budgets. So to put it very simply, or to be more specific, what we do is we identify the core cost creating factors, or cost drivers of each activity or each numbers that we're trying to budget, and then try to control it accordingly as well. It is very useful when it comes to complex organizations. Okay, folks. So that's basically the idea behind ABC as well. Again, it has its own difficulties as well. For example, identifying cost drivers is not that easy, right? There could be multiple costs having the same cost drivers, or there could be multiple cost drivers for a particular activity as well, right? So that's basically the idea. Okay, folks. So that's also another type of budgeting which we have to learn about as well. So these were basically the types of budget. We have incremental, which is a traditional approach, zero-based, rolling, as well as APB as well, right? So other than all of this, right, there's another concept of budgeting known as beyond budgeting as well. So what is beyond budgeting all about? So in this particular concept, we're saying that the proposed traditional form of budgeting needs to be abandoned, right? We don't need this particular approach anymore. Why? Because it has a lot of criticisms and limitations. For example, I'll give you a typical criticism of the normal way of budgeting, right? When we set a target, let's say material cost is set at $100,000, right? Each and every manager will try to achieve this $100,000 target, right? No one thinks of going above and beyond the budget, right? For example, they won't try to reduce the material cost. They're only going to say that, hey, I have $100,000 of material cost allotted, so I am going to use it for the full extent. I'm not going to exceed it, of course, but I will still use it. So the criticism is that they try to, in the traditional form of budgeting, they try to protect the cost rather than save them, is what we are trying to say. So we have this new concept known as beyond budgeting, right? So in beyond budgeting, the idea here is to focus on things on a bit more qualitative terms as well. Okay, folks. For example, the managers are encouraged to take their own decisions when it comes to beyond budgeting, right? And for the organizational benefits, managers would have to focus on not only the financial aspects but also the non-financial aspects, such as customer satisfaction, quality related aspects, right? All of these things needs to be improved as well, right? And what else? Yeah, they should have the appropriate amount of information systems and other resources to pull this off as well, right? And their focus should be on the long term rather than the short term aspects, because the conventional way of budgeting has a tendency to make people focus on just the short term rather than the long term, right? So which is why beyond budgeting says that, hey, don't just focus on this, don't just focus on the short term, but also focus on the long term aspects of the organization as well, right? So that's basically as to what beyond budgeting is all about, to put it in very simple terms, that is. Now, moving on to the changing budgetary system. So what's the idea here? Again, when you change from one particular budgeting system to another, right, what's going to happen exactly? When you change from one particular budgetary system to another, what's going to happen is, there would be resistance by employees, first of all, right? resistance by employees, what does that mean exactly? Because when you change from one system to another, whenever a change happens, right, change is always kind of frightening if you think about it, right? Because whenever a change happens, we'll be like, hey, why exactly what exactly is gonna change? Like, is it gonna affect my job? Is it gonna affect my lifestyle? Is it gonna affect my the way that I do things each and every day, right? So that's basically the thing. There is a fear when some sort of change happens like this, right? So that's exactly what resistance by employees means. Okay, folks. So whenever we say that, hey, let's just change from the incremental budgeting to zero based or something like that, people will feel like, okay, this is something new. We're not aware of it. Why can't we just move back to the way things were already, right? So that's basically the idea. Okay, folks. So what else? There's of course loss of control as well. Like we might lose our control over certain items as well, because since we are doing it for the first time, right? So that's basically something. And of course there is always an implementation cost whenever we implement something for the first time, right? So there would be unnecessary inefficiencies happening. There is obviously a learning curve, right? So that's basically it, which leads to my next point, which is basically the training requirement as well, right? So people need training, right? They're not aware of what's going to happen with this new system. They're not aware as to how to use the system more effectively and efficiently. So they need the training, they need the education regarding that particular system, right? And finally, there would be a lack of accounting information as well. For example, for the new system, if we are not up, see, each budgetary system would have its own information system requirements. So if it's not happening, then obviously there would be an issue, right? So if we don't have the information system, the appropriate information system with us, then that can cause a challenge, right? So that's basically what is mentioned over here. So yeah, that's basically all about the budgeting related concepts. Now moving on to some techniques which we have revised throughout our sessions, which is basically the high-low method. In high-low method, what do we do exactly? In high-low methods, what we do is we basically just take the highest amount of activity and the lowest amount of activity, right? So the equation is the amount of the highest level of activity minus lowest cost, as in highest cost minus lowest cost, divided by the highest activity minus lowest activity, right? So why do we use this particular equation? We just use it so that we can simply calculate the variable cost per unit, right? There would be semi-variable costs that are there in our organization. So we use high-low method to separate out the variable cost and the fixed cost components. Okay, folks, so that's basically the idea here. And of course, we also looked at the learning curve theory as well, right? So what is the learning curve theory all about? It's all about how the workforce improves efficiency with experience, right? Maybe the first time that I'm doing a particular job, I may not be that efficient, right? Let's say that I'm making an omelette for the first time, right? So I may take like 10 minutes or maybe 15 minutes, right? Because I don't know how to do the right and appropriate things, right? So, but if I repeat the job again and again for some time, then I might become more and more efficient, right? Maybe the first time that I made an omelette, it took like 10 minutes. The second time, it took 9 minutes. Third time, it took 8 minutes. Down the line, we will, reach maybe 5 minutes or maybe even 3 minutes, right? But nothing below that, right? Because, there is an actual time. We cannot be as efficient and become, and make an omelette in, let's say, 10 seconds, right? That's not physically possible, right? So, learning curve theory suggests that initially, when you start doing a particular job, there would be some inefficiencies happening, due to which you may take more time, but gradually as you repeat the process, the particular timing will reduce on a percentage basis. Okay folks, so that's basically the idea behind the learning curve theory, and it will reach eventually a steady state where the learning curve will disappear as well, right? So that's basically the idea. That's what a learning curve is all about. And of course, we also learn about standard costs as well. So when it comes to standard costs, what's the idea here? We are setting, estimated unit costs, right? So that's basically the idea here, right? We're setting up estimated unit costs. So when it comes to estimated unit cost build-up of standards, what all things are we learning here? We're learning about the types of standard first of all. there are 4 types, right? There is the ideal standards, attainable standards, current standards, as well as basic standards as well, right? So ideal standards are basically those standards which we set up at the very top level, or at the well, it's basically when we set the bar at the most perfect level, I would say. Okay, folks, so we're assuming that everything will go right, nothing is gonna go wrong, no efficiencies, no inefficiencies, no wastages. So what would be the ideal scenario is what we look at when we set up ideal standards. Okay, folks. But the problem with ideal standards is that chances are it may not be achievable, right? Chances are there would be too much of adverse variances because practically it may not be achievable. Why? Because there's always something that goes wrong, right? We may plan something, but something else happens, right? So that's basically the idea. Okay, folks. That's why ideal standards, are considered to be inachievable in most cases. Okay, folks. In most cases, that is. Secondly, we also have attainable standards as well. This is when you set the bar at the right level. Okay, folks. So we set the bar at an achievable level that can motivate people to achieve it as well, right? So it is achievable and people are motivated to achieve it as well. That's what attainable standards are. And of course, we may provide some allowances for wastages and other inefficiencies, but still, right, it is still achievable and people are motivated to achieve them. And of course, there is the current standard. So we look at the current business conditions or manufacturing conditions and then set the standards accordingly. It is like a bit more easily achievable because we are providing allowances for a lot of things that can go wrong, right? So, but employee wise, they are motivated to work and everything because it is achievable, right? But from a business organization's perspective, like, it might not be that attractive, right? That's basically the idea. That is, they may not prefer this because people are not motivated to go above and beyond, right? So that's basically the idea. And finally, we have basic standards as well. Long-term unchanged standards, right? So these are basically long-term unchanged standards, and it's more suitable for stable businesses. Okay, folks. If your business environment is stable, then we can use basic standards, and basic standards are not updated for the long term, right? So chances are there's a high likelihood that basic standards can get outdated as well, right? So that's basically the idea. So out of the 4 types, I would say that the attainable standards is the most perfect, isn't it? So that's basically something to consider here. Remember, guys, MCQs and stuff like that can be tested. Don't take most students, when it comes to this particular paper, they tend to take the theory a bit more lightly because most people have this misconception that the PM paper is a calculation based paper, but no, it's not, right? It's 50% calculation and 50% theory as well. So be very, very mindful that there would be theoretical questions, MCQs, and case study questions that can come up in the exam. Okay, folks. So yeah, keep that in mind. And of course, there is also flexible and flex budgets as well. So the idea here is simple, right? Flexible budgets are those budgets which we create depending upon different activity levels. Okay, folks? At different activity levels, be it 10,000 units, 20,000 units, 30,000 units, what would the budget be is what we look at when it comes to flexible budgets. Flexed budget is when you flex the current budget based on the actual results. Okay, folks? I may have already planned on manufacturing 10,000 units, but actually I was only able to manufacture 8,000 units due to resource constraints or whatever reason, right? So what I'm going to do is, in order to make my budgets a bit more comparable, I'm going to change my fixed budget, which I initially planned with 10,000 units to 8,000 units. Okay, folks, how would my numbers be had I manufactured or had I planned for 8,000 units? This is what a flex budget is all about, to put it very simply. So yeah, flex budget shows expected revenues, cost and profits for the actual level, activity level. Okay, folks. So yeah, simple as that. And of course, there are some small principles that you need to learn, which is such as the principle of controllability, because we're only holding people accountable for the factors that they have a certain level of control over, right? So that's basically the idea. And then of course, we also have variance analysis as well, which is like the most terrifying topic that a lot of students find kind of difficult, right? So that's basically the idea. So when it comes to variance analysis, what all things do we look at? The difference between actual and expected results, right? That's basically what we look at, to put it very simply. And there can be adverse and favorable variances as well, right? So what's the idea behind adverse and favorable variances? Favorable variances are those which are good for the organization, whereas adverse variances are when things didn't go according to plan, right? So that's basically the idea. So there are multiple equations which you have to learn under this. So I've created a small formula. You guys can take a screenshot or something if you want as well for this particular formula list, because that would be quite helpful for you guys, right? So go ahead. So for material cost variance, what are the formulas that we have? For material price variance, we have AQ times SP minus AP. For usage variance, we have. So again, guys, first of all, think of the brackets. Think of what's inside the brackets first of all, okay, folks? So for the price variance, I'm comparing my standard price minus actual price, and to have a common base, I'm multiplying with AQ, right? To put it very simply. And for my usage variance, I'm comparing my standard quantity with actual quantity, and then I'm multiplying it with the standard price. All of these equations are kind of on the similar lines as well, so it's always easy to remember these if you go on a conceptual basis. Okay, folks, for example, if I'm looking at the labor rate variance, right, I need to understand the difference between the price, right, first of all. So inside the bracket, I'm writing standard rate minus actual rate, and I'm multiplying both of these with AH, which is the actual hours as well. And then I have the efficiency variance, which is SH minus AH times SR, which is the standard rate. And there's also the labor idle time variance, which is abnormal idle time multiplied by the standard rate per hour. We have overhead variances as well, right? Variable overhead expenditure variance would be standard rate minus actual rate times the actual hours as well. Again, remember guys, standard rate is not the labor rate or anything, so don't confuse it with that. Even though the equations look similar, we are considering the fixed overhead absorption rate. Okay, folks, so remember that. Variable and fixed overhead absorption rate. So remember that. So yeah. We have SH minus AH times SR, and for fixed overheads, now this is a bit confusing, but it is conceptually kind of easy to learn as well. So for the fixed overhead expenditure variance, we have budgeted overheads minus actual overheads. For the volume variance, we have standard hours minus budgeted hours times standard rate. For efficiency variance, we have standard hours minus actual hours times standard rate. For capacity variance, we have actual hours minus budgeted hours times standard rate as well. And for the sales variances, it is kind of similar but slightly different, right? For the price variance, we have actual price minus standard price times actual quantity. And then for the sales volume variance, we have actual quantity minus standard quantity times standard profit or contribution as well, depending upon the question. Okay, folks, so this is basically the equations that we have. Remember guys, remember how to expand the equations and use the information in the scenario to apply these equations as well. That's really, really important, because I can guarantee you that it is a definite question in the exam, either as an MCQ or maybe even as a case study question as well. Okay, folks, so just be very mindful. And of course, we also have the mix and yield variances as well. Conceptually, what are these? When it comes to mix variance, we are looking at the actual mix and the standard mix. Okay, folks. So as per our standards, how are we supposed to mix the quantities, and what have we actually done, right? Both of these are compared and to see what exactly is the difference, right? So that's what mix variance is. Yield variances are those variances which are between the inputs and the outputs, right? So have we achieved the output which we should have achieved from the inputs that we had, right? So that's basically the idea. So the relationship between mix and yield variance is that if the mix variance is favorable, then the yield variance would be adverse, and vice versa as well. Okay, folks, so that's a really important relationship to know as well. And the same goes for sales mix and quantity. Over there, we were looking at materials used and quantities, and over here we are looking at the quantities sold. Okay, folks, units is what we're looking at. So again, sales mix is kind of similar to the material mix variance as well. We again compare the proportions of the goods sold, right, from the standard to the actual, and see what the variance is. And the same goes for quantity variance as well. It's kind of similar to the yield variance itself, right? So that's basically it. That's basically the idea. And now moving on to operational and planning variances. Then again, like it's yet again another really easy concept if you know the concept, right? So basically, what is planning variance? Planning variance is basically when the variance has occurred due to factors that are outside our control, right? So that's basically the idea. And operational variances occur due to factors which are within our control as well. Okay, folks. So that's basically the difference between these two, to put it in very simple sense. And moving on to, and of course you have to learn how to revise those equations, variance analysis equation using this as well. Remember guys, the initial budget minus revised would be your planning variance equations, and the revised budget with actuals would be your operational variance equations as well. And then we move on to budgetary slack or bias, right? So what's the idea here? So guys, there is a high chance that budgets can be manipulated, which is kind of obvious if you think about it, right? So the idea here is that we do not need our budgets to be, set under capacity. For example, we may have a capacity to sell maybe 10,000 units, but we don't want to, set our budgets below that capacity, right? Then it would cause a budgetary slack, right? Because the manager would just be trying to ease out the budget so that they can show good results, right? So we should always ensure that we're setting our budgets based on the capacity that we can achieve as well. So yeah, that's basically the idea behind budgetary slack. And yeah, that's basically it. That's basically all I wanted to cover in this particular session. I hope you enjoyed it, and of course guys, stay tuned for the next session where we will be looking through the last syllabus area. And of course, I'm just covering the key topics here so that you can revise through everything conceptually. And of course, numbers are pending, I know, so go ahead and revise through those example numbers which has been provided through your notes or any other resources that you may have to to revise through the numbers and how to calculate things once again as well. Okay, folks. So yeah, just be mindful of that, because again, numbers are also important. So yeah, keep that in mind as well. And in the next session, of course, we will be looking into part E, which is performance measurement and control. And then we will be talking about some exam-based tips and techniques as well. Okay, folks. So till then, this is Vishnu Vijay signing off.